if you want to have a happy life, is to have really low or no expectations. Like Warren Buffett once said, if you want to have a successful marriage, have no expectations or low expectations. If you don't insist too much that you're right, you allow for room for your own human misjudgment, then you might get pleasantly surprised.
Welcome to Personal Finance Cat, where I share my personal take on personal finance. Hello, Michelle. Welcome to the show. How are you?
Thank you for having me, Handie. I'm so grateful to speak with you today.
Thank you. I really appreciate it. So, Michelle, you're a YouTuber, and I started noticing you when you were commenting on some other YouTubers' channels. And I think you and I have very similar investing philosophy. And that's why I reached out to you and was hoping we can talk. To start with, can you tell us about your investing philosophy and how you approach finding value in the market?
Well, I learned about Warren Buffett and his style of investing over the years, and I found out about Warren Buffett through listening to some investing podcasts, especially this podcast called Invested by Danielle Town and Phil Town. And a lot of people consider Warren Buffett's style of investing to be like value investing, but I try to move away from that term a little bit because some people have very kind of negative connotations of value investing and value stocks, and they think that you're buying just cheap stocks and that may have low growth and are not that exciting. But in actuality, some of how Warren Buffett invests is by getting sometimes growth stocks at a reasonable price, or also known as GARP. And one of those examples is Apple stock that they have a ton of, and it's their number one equity position. So I like to think of myself as an investor who is trying to be like Warren Buffett and his business partner, Charlie Munger. And that's basically what guides me in everything I do. Like, I've tried to learn as much as I can about Warren Buffett, and I read his annual letters, and I'm trained with the style of how Phil Town and Danielle Town have instructed their listeners and also their readers. So I highly recommend their book, Invested, also of just giving you straightforward approaches and formulas of how to value businesses and therefore stocks that we might want to consider investing in. So that's basically what governs my investing style.
That's awesome. Yeah, I read that book. It was a wonderful book. Like you said, it's very straightforward, very easy to follow because the author herself, she's a lawyer, but her dad has been a well-known value investor. So it's their journey to try to learn together how to value different stocks and other investment opportunities. So agreed, I definitely highly recommend that book as well. So then can you tell us a little bit about how you go about valuing stocks? Are you just following the approaches or methods that Danielle Town and Phil Town teach?
Yeah, mostly. And there's another book that I read, and I met the author, and he's also an investor, named Adam Cecil. And his book is called Where the Money Is. And that one talks about how, we want to apply some of the principles of Warren Buffett, but update them for tech stocks. So, for example, if you want to value Google, or aka Alphabet, or Facebook, aka Meta, it may not be as obvious if you just use more traditional metrics, but if you update them, like adjust for some of their operating margins and things like that, you might find a more appropriate price to understand that even though it seems like they're trading at higher price to earnings multiples, they're actually maybe more reasonable than one might have assumed. So depending on how you calculate the valuation for some of those tech companies, you might come to find that they could be on sale, even though at first glance, if you see like a crazy PE number, it might seem like too much just because you're like, oh, I know the stock market's historical average should have been around 16 PE, but then you're seeing some of these tech companies in the 20, 30, or 40 PE range, and that might be like, it just at first glance seems too high, but then you have to look more beneath the surface. So I think it helps to also put that in a frame of mind.
That's great. Yeah. So I'm so glad you mentioned that because I was wondering about that too, because even Charlie Munger bought Alibaba stocks, right? And their PE ratio was pretty high. So I was always wondering how he sort of made the decision to invest. And recently, I also did an analysis and a video on how I valued Meta stocks, because if you remember, towards the end of last year, their PE ratio even dipped to like 8 or 9 or 10, which was unheard of for a tech company like that. So I bought in, and I'm glad I did, because it more than doubled at this point. I wish I bought more, but it
Oh,
is.
that's amazing.
Yeah, but I'll definitely check out that book. Great recommendation. Thank you. So, do you have sort of a general approach of how you balance risk and reward? Because you mentioned growth stocks, and then I know there are different reviews about what is a growth stock, right? Is it really just kind of high growth, high PE ratio, or can it still be, a established company that just has value, but maybe is going through some sort of an event which made their price go down? So, kind of, what's your view on maybe the more qualitative aspect of doing research?
Well, with when you were asking about risk and reward,
Hmm.
what I've learned, and this is straight from Phil Town, who got it from Warren Buffett, is to remember rule number one, which is to never lose money, and to rule number two, don't forget rule number one. So that's my idea of risk: is I never want to lose my original principle on something. So I try to build in a margin of safety, which is an engineering term that Charlie Munger came up with and applied that to investing, and he's known for talking about margin of safety. And I think that between Ben Graham and Charlie Munger, Buffett credits those guys for including this concept of margin of safety when you're trying to make an investment, where you're trying to buy something at a discount to what something is really worth or its intrinsic value. And that discount could be anywhere between 10% to 50%, depending on how much of a discount you're really aiming for. And that enables you to have a cushion, because just like there are bridges when we're driving on roads that say the maximum weight limit, that would be a margin of safety, because you don't want a truck that's at the full maximum, that's at the heaviest the bridge can handle, and then it could risk falling apart. So bridges have margins of safety, and I think that that's what we should also try to include when we're investing. So I don't have a specific measure of risk, and some other investors like Howard Marks don't believe that you can quantitatively measure risk. So I know there's a lot of academics who believe that, oh, you measure risk with beta and volatility, but if you're more of the Buffett style, you don't even care about some of those measures. It doesn't even factor in. It's more like, can you permanently lose money by locking in a loss? Like, so even if you're down on a stock, you haven't really lost until you've actually sold. So you have to weigh the consideration of, am I likely to actually lose my original principal on this investment? And that's what I go by. So I try to not lose my original principal, if you will. So that's my main way that I think about that. And I think you also had a question related to some of this of quantitative or qualitative
Right.
measures.
So I think you touched on it a little bit, because to me, I feel like I'm on the same boat with someone you referred to, that it's really difficult to quantitatively value risks, right? So, or determine risks, I should say. How do you determine risk from a more qualitative point of view? Because I know that some of the value investors would, stay within their circle of competence because they know the business so well. They know that your risk is mitigated. So can you talk about how you go about determining that?
Yeah, and the way we can think about risk is if we were the actual business owner operating the business. So if we put ourselves in the shoes of the CEO and they need to perform, and there's a business's underlying economics, and one way that we might think about risk is what could be potential competitive disadvantages to a company. And one example that recently was coming to mind for me was with how ChatGPT could pose a risk to Google's business model of ads and search. And so one has to try to weigh what are the probabilities or odds that ChatGPT can unseat the business moat that Google has in place? And is it likely that Microsoft can, overtake Google, let's say, in leveraging ChatGPT? Or will Google have its own AI-based search and that can help reinforce its moat? So just when we think that ChatGPT is going to breach Google's moat of how they do business, it may not, or it might. So it's kind of hard to really know for sure what's going to happen in the future. But based on these potential competitive risks, we have to try to see, is Google continuing to perform downward? Like, are they losing market share in the ad revenue business, or are they able to hold steady? So those same questions also might have come up for Meta because of their struggle against TikTok and trying to get Instagram to, hold off TikTok. And yet, in many ways, TikTok has unseated Instagram for a while. So we have to kind of consider how well at the business fundamental level, are these companies able to maintain their current business model, or do they need to change to improve their business model, or is their business model starting to die and they're not adapting fast enough and not innovating quickly enough to regain market share? So those are some ways that, and there are other kinds of risk, like the management risk, like looking at, can we trust the CEO? Like, do we believe that they have integrity and talent? And do we think that they can make the right capital allocation decisions for the company? And some of this we can discern from reading their annual or quarterly letters if they release them. And there are a bunch of red flags that we can pick up on how the management is performing. And some of that can be both qualitative and quantitative. Like, we can measure qualitatively from their letters based on things like how Laura Rittenhouse's book has talked about investing between the lines. So I highly recommend that book to understand, if CEOs are being straightforward with you and exhibiting candor. And Laura Rittenhouse is very well respected in the investing community. Like, she knows Warren Buffett, and he's even talked about her in one of his annual letters at least. So she is a pretty great source to go with how to analyze CEO communication. And then quantitatively, we can look at the return on invested capital if this is going up over time under a CEO's leadership. So those are some factors to consider also of, like, is the CEO a risk for the company, or are they mitigating risk? So that would be also an avenue I'd explore.
Sounds great. And it sounds like you're very knowledgeable about the tech companies by the examples that you mentioned. Can you talk about what your circle of competence is, if there is one area, for example, that you kind of focus your investments in?
Well, I'd usually stick to kind of the more consumer or like some tech, but even though I might seem knowledgeable about tech, I may not be that knowledgeable because I've never worked in it directly. So I'm sure if, people who work for Google or Facebook, they might actually know what it's like, and they would have a great circle of competence to know whether their own companies are potentially good investments or not. But usually I stick to things that I feel like I can trust the management. So even though Berkshire Hathaway is still pretty complicated to me, I trust who's running it. So I would be likely to invest in that, or other companies that I've worked at before, like Starbucks. So some of these companies are, kind of ones that either you feel like you can trust, or that, like, I feel like coffee is pretty straightforward and easy to understand, and it's a consumer-based business. So I think a lot of consumer-based businesses you could kind of come to understand as long as they're not too complicated. Like, there are some businesses that have so many brands and subsidiaries, and those could be a little bit complex. But if you have one that's pretty easy to understand, like McDonald's and Pizza Hut or Domino's, like, some of those are pretty obvious, like how they do business. So if you think about what things naturally make sense to you, then maybe it can be, a way to explore potential investments. Because earlier this year, I was trying to learn about Taiwan Semiconductor because Berkshire Hathaway had invested a lot in that. And then they pulled out of a lot of it. So they went from having more than 4 billion invested in TSM to now only like 600 million. So I thought that was peculiar. And so it kind of gave me pause to the semiconductor industry. Like just when I felt enthusiastic about learning about it, like I didn't invest, but I kind of just wanted to see if it were in my circle of competence. But then now, since it may be a little tricky for even Berkshire, I'm like, well, I'm just some amateur investor. I'm not even at the level that they are with his investment lieutenants, Todd and Ted. So if it's too hard for them, maybe it's too hard for me. So yeah, like things like that, you really have to consider, what your own limits are to what you're capable of understanding.
So how do you kind of stay kind of disciplined to not be, I guess, sidetracked by those distractions?
Well, the good kind of thing is if you develop your own sense of convictions about what is what. Like, of course, I'm heavily influenced by likes of someone like Charlie Munger, who has strongly denounced crypto, and how Warren Buffett at last year's annual meeting, and they both talked about crypto in previous years, but in last year's meeting, Warren Buffett said, if you gave me all the Bitcoin in the world, I wouldn't buy it for even $25 because what would I do with it? It would just sit there. It doesn't generate, income on its own. It's not like farmland or an apartment building near NYU, which can generate rental income from the tenants and the residents. So unlike these real assets that produce income from what they offer, farmland offers crops and apartment buildings offer space for people in New York City. Like those are legitimate things that can produce cash flow. And the same with like most businesses. That's why America continues to be prosperous. But if you just have something that I like how some people have called crypto of like imaginary money. It's just a bunch of, kinds of zeros and ones on a computer. And even though a lot of energy went into mining them, and, I enjoy studying some, blockchain technology. I think it's fun to learn about. And I think that it could be appealing if established companies could integrate the blockchain technology to make, banking safer, or perhaps maybe mortgages and deeds might be, transferred on a blockchain someday. Maybe those things could be promising, but just the notion of kind of people trading Dogecoins or Terra or Luna or all those different ones that, kind of seem to have questionable utility. I feel like I've never been that interested in that stuff. And I think the last time I was ever, so excited about things that have questionable value may have been Pokemon cards when I was 12. So, at that time, we're like, ooh, a first edition Charizard, and like, this is like worth a lot, maybe, right? But, it may or may not be. It's just a picture, like it's a really nice looking holographic picture on a piece of paper. But at the end of the day, it doesn't necessarily have that much intrinsic value. Like, no matter how much people covet the Charizard card, it will not produce cash flow by itself, unlike farmland. So if we think about it like that, there's a lot of people who may have made YouTube videos on the hype about crypto, and those people were productive about it. Like they made money based on, people's attention of wanting to learn about crypto and all that stuff. But in my opinion, if people were actually in the coins themselves, it may have been pretty much like gambling. Like you're lucky if you made money out of it, but you shouldn't necessarily expect to make real money out of it, because it's kind of like nobody knows what's going to happen, and it's kind of hard to value what the value of a network really is. Like, of course, some blockchain networks are as strong as its supporters and people who are really into it, but I don't know how far that can take things without it being rooted to something in reality. So those are just some things to consider. So there's definitely a lot of things that are promising about crypto, but like I never was convinced that I could do anything with it. And so like it was pretty easy for me to stay out of crypto. Like I've never even had any digital, like no cold or hot wallets, like none of those. I never like did anything there. So, and also with all the scammers, like that just kind of scared me. So I was like, I don't even want to, like, I don't even want someone to like cell phone hack me and then, use my SIM card to break into my crypto wallet. Like, that all just sounds too scary of like the horror stories I've heard. So that one was easy. But when it comes to like actual stocks, of like seeing my investments go down by 50 or 60%, that can be kind of nerve wracking. And even though it used to bother me somewhat, especially when I was a newer investor, I think with experience and time, if you develop a sense of conviction in what you're investing in and you have an investment case before and against what you're invested in, you can then realize, okay, these are the reasons why I got into it, and these are the reasons why I maybe should get out. And if you know what those conditions are, you know the limits of your knowledge, and you know when it's time to get out of an investment, then you don't freak out as much. And I think that's helped me, is just becoming more knowledgeable about what I'm invested in. Because the only reason why, if some people might have bought a stock because it pays dividends, but they don't really care. They spent like 2 seconds to buy the stock. And I used to do that when I was like in my early 20s. Like, I bought Verizon because it gave some dividends. But then I was like, why am I in this? And it's going nowhere. And I haven't studied it. I just literally bought it because it gave dividends. And so after a while of it doing nothing really, I sold that because I never studied it. And I realized that that was just silly. So a lot of people just do that. They just buy it for either dividends, or they think that it's going to go up in price, but then as soon as it goes down in price, they're like, oh no, like, I'm losing money. But that's only like paper losses until you lock in a loss. So I think a lot of this just comes with getting the experience that you need and going through enough trial and error situations that you become a hardened investor at some point, like battle tested, once you've done it enough times and watched your investments crater. But even if it goes down by 50 or 60%, you have to just kind of ignore it, like not let it bother you. So even if that happened, you just have to either keep the faith or just be like, well, I have no choice but to hold on to it, because if I sell now, I'm going to lock in the loss. So what's the point of that? So you might as well, as I'm suspecting maybe Daily Journal did that with their current BABA holdings. I'm surprised that they haven't sold, but even though they did most likely some tax loss harvesting before, they're probably keeping their remaining amounts in it, and I'm guessing they're just going to hold on to it until they at least break even, or they might even make a profit someday if Alibaba recovers, or they split into the 6 companies, and then maybe they'll stick with the winning ones. Who knows? But we'll see what happens with something like that. But yeah, at some point you're just kind of like, you try to do better the next time. You, like Charlie Munger says, you just try not to make the same mistake twice if you can.
Yeah, very well said. What about like the shiny objects that are still not completely speculative, like crypto, right? So AI, you mentioned just now, which is definitely an area that everybody can see it's very promising, but then maybe it's outside of our circle of competence. So how do you sort of stay disciplined and know kind of you can't just jump in whatever is the hottest stock and just buy it because other people are buying it? So can you talk about that a little bit?
Well, that's where, like, we have to try to be aware of where our limits are. So being that I wasn't really sure how AI will affect Google's business model, I sold out of my Google holdings because it made me wonder if I should buy it at even a lower price, considering this new potential risk. So I might have paid too much for Google at the time when I thought it was on sale. And so, sometimes things like that, I'm saying to myself, maybe AI is still too early for me to fully understand, just like how Buffett for the longest time didn't understand computers, but then he eventually maybe understood things enough to finally buy Apple in 2016. But until that point, he just stayed away from tech and computer stuff for the longest time. So even though he's like pretty good buddies with Bill Gates, that never influenced him to buy into Microsoft when he could have, like, in the 80s or 90s, maybe. Like, he could have done super well with Microsoft, but he refused to kind of like go into that if he felt like he didn't understand it well enough. So, with things like that, we just have to try to be honest with ourselves of what we realistically think we can understand. And so far right now, AI is a little bit out of my circle of competence.
Got it. That makes total sense. If you don't mind, can you share the biggest investing mistake you've made?
Probably like paying too much for assets, like paying too much for the securities that I was in, and then also trying to stubbornly believe that it would recover, and then being wrong. So, I've taken a loss before on things that I was stubborn about. Like I was like, oh, based on the research and the back testing I did, it should be able to recover, and then I was just, not willing to throw in the towel. And I think that can be what does us in. So it could help that if we write down the rules and we stick to them, and we're like, okay, it broke through this floor, and even though a floor is like a stock price level, like say you bought it at 100 and it goes down to 80, and you're like, okay, this is the loss I should have taken. I should have been okay with selling it at 80, but then you still hold on to it to like 70 or 60. That's where I may have made a mistake of like, I thought it would recover from 60 back to over 100. So, I should have, when it hit that floor of 80, I should have been like, okay, time to sell, get out now. So that was a mistake that I've made of like, just, it's more like human psychology of just where you think from your own human error, like my hubris made me hold on to something that I should have gotten out of much earlier.
And then on the flip side, what do you think the most valuable lessons that you learned from the value investors such as Warren Buffett and Charlie Munger are?
Well, one of the most valuable things I think is, if you want to have a happy life, is to have really low or no expectations. Like Warren Buffett once said, if you want to have a successful marriage, have no expectations or low expectations, because some people think that they can change other people, and I try not to think about fixing someone else. I try to think about like accepting people as they are, and I think if we try to lower our expectations with anything, whether it's people or the stock market, if you don't insist too much that you're right, you allow for room for your own human misjudgment, then you might get pleasantly surprised. So I like that kind of lesson, and also, beating to the tune of your own drum. Like there's a reason why Buffett lives in Omaha and not in New York City, is that it helps to get away from the noise. And I think also if you can live according to your own inner values and not be governed by what other people are doing. So, things like a lot of people were really into crypto, right? It was the hot thing to be part of in 2021, but those were not my values. Like even though it's popular with everybody else, I don't care for it. So I think it's important to live according to your own inner values, and if you can do that, you'll be more likely to be happier. So I think that those are some of the most valuable things I've learned from Warren Buffett and Charlie Munger.
Yeah, I love it. I think I heard him talk about that a lot too. I definitely agree. All
Mm-hmm.
right. So then, what advice would you give to new investors who are looking to adopt a similar value investing philosophy?
Well, new investors should definitely study as much as they can before they, just jump in the market. But it also depends on what kind of person you are. You might be a little bit eager. So then maybe it would be a good idea to use real money, like something that you can afford to lose, and you won't be too upset if you were to lose, say, $100 or $1,000. And after you try to do some of your homework, invest a little bit at a time, like maybe buy one or two shares of something and see how it makes you feel, and then try to monitor your own feelings about something, of how you're reacting to the ups and downs of that stock. Because you could read lots of books and you could do paper trading, but that's not going to scare you like having skin in the game is going to maybe incite certain emotions. So I think it's to test your temperament and see how you just fair just with yourself, because, more so than figuring out companies on a logical way, the bigger hurdle is your own human psychology. So if you can master yourself, like that is what a lot of investing is. It's like an art of your own human behavior and controlling yourself. So that would be one way that I think other newer investors can test their mettle, is just try it out. Like through trial and error, we learn a lot, and I think sometimes that can even be a better lesson than the ones we get from books. Are the hard learned lessons from our own mistakes.
That's awesome. Thank you. All right, so maybe let's switch gears a little bit, because I do also want to ask you about your social media presence.
Mm-hmm.
Can you share with us, when did you start your YouTube channel, or the first kind of more public social media presence?
Yeah, that was in September 2020. My YouTube channel launched.
And how did you grow it, and how did you kind of promote and advertise your YouTube channel?
Well, I've not ever paid for advertising, so it's just from my own efforts. But like you mentioned earlier, when I've commented on other YouTubers' videos, like some of that helps to, by commenting and showing sincere interest in other people's videos, other people might come to find you and then check out what you might offer. And I just try to copy some of what other popular YouTubers have done, like Graham Stephan. He puts his face on his thumbnail. So I thought, okay, that seems like a way to get some audience to get to know me. Like, when they click on the thumbnail, they'll expect to see my face and talking to them. And those are some of the ways that have helped me. And, just trying to disseminate some of my YouTube posts across either Instagram and Facebook and Twitter, and also on my blog. So by having a presence online, hopefully that sort of finds some people, and I'm pretty open to helping people on whatever way they feel like engaging with me. Like some people email me and they DM me on Instagram or Twitter, and then I try to answer their questions if they need help with, like, for example, somewhere trying to go to the Berkshire Hathaway meeting. So I've been answering some people's questions because I went to that for the first time last year. So I'm just trying to be helpful to people, and yeah, just like kind of spread the knowledge, because I feel like I'm very fortunate and I'm just grateful to be able to, be in this country. And like Buffett said, like if we're in America, it's like kind of a big land of opportunity, and I could have easily been from like another country that doesn't have as much opportunity here. So I just feel very lucky and want to pay it forward to other people of, all the things that I was, fortunate to learn about. I feel like it can be helpful to other people's learning journeys for their personal finances or learning how to be an investor. And I just happen to feel like this is one of the better ways that one can invest. Like, it's not the only way. There are many roads to success. So, even though I happen to like this kind of style of investing, it doesn't mean that it's the only way. So, I'm also open to learning other ways that could be good ways to invest too. So, hopefully other people will find me too, and they share, what ways are helpful for them. And then I can learn something from other people's financial journeys. So yeah, that's some of, what I've done to try to get out there more, to have more of a presence of trying to just, be part of a positive feedback loop of, like, if you can be part of a flywheel of, giving to people. I think the more that we give to others, the more the universe will come back to us in a hopefully positive karmic way.
Yeah, very well said. So what's your grand vision for your YouTube channel, or maybe kind of your own brand?
Well, I guess it's more like a hobby. So I just try to, be helpful. I mean, it would be cool if there were more, subscribers. I will not take, say no to if people want to subscribe, but like, yeah, basically I'm just trying to keep it kind of casual, not be, like I mentioned earlier, kind of keep low expectations. And if it works out to something bigger, great. And if not, I at least I helped a few people along the way, and that makes me feel good at the end of the day. Of like, for the few people that I may have positively impacted their lives, that's kind of good enough to me, because I try to help my friends and family, and so it just yeah, I just want to be part of a community of people who try to help people, and that's good enough for me.
Got it. Got it. That's great. Do you have any other influencers or value investors that you would recommend to the listeners?
Yeah, like Guy Spear is great, and Monish Pabride. They're good buddies and disciples of Buffett style investing. And also, there's a lot of great learning content out there from like podcasts like the Investors Podcast Network, and they had their flagship podcast, We Study Billionaires, and they also have another podcast that I was on called Millennial Investing, and it's just great to learn from many different kinds of investors, and there's also, of course, lots of books like I mentioned earlier. Laura Rittenhouse and Adam Cecil, and Warren Buffett also likes this book, Common Stocks and Uncommon Profits by Phil Fisher, and I've yet to read that, but I've heard really great things about that. So, there's one thing that we can learn a lot from, and these would be dead influencers, and I think it's kind of funny how Phil Town talked about dead influencers, like Phil Fisher or Ben Graham have passed away, and we could learn a lot from those guys. So, we should look to a lot of books for some really great material of ways that we can just grow as human beings and investors, and other things that I think are just helpful for getting along with people are things like from Dale Carnegie's How to Win Friends and Influence People, and also Richard Cialdini's book Influence. So some of those would be ways that we can just self-improve, and I'm a really big fan of trying to self-improve. So whatever way that we can get along better with people and help others, I feel like is part of my purpose as a human being, is just I want to grow as an investor and also help people at the same time.
That's great. That's great. I think you just answered my next question, which is book recommendations for either investing or improvement. But anything else you want to add to that? Any other books that really helped you?
Another great teacher is Adam Mead, and he came out with this big book of great reference called The Complete Financial History of Berkshire Hathaway, and I've interviewed him before on my YouTube channel and podcast, and he's also a really great resource. And he has a YouTube channel called The Oracle's Classroom, and also he's on Twitter as BRK_student, and he also has this heavy duty newsletter that's a paid newsletter called Watchlist Investing. So he's also a really great resource, and this other investor named Chris Bloomstrand. And also, like, there are just so many great investors out there, and it's really a matter of, if you find ones that you either watch, YouTube videos about, or read some of their letters, you could learn a lot from. Like, I've heard great things about Rob Vinall and also Matthew Peterson, and also, even though this investor is no longer investing publicly, Nicholas Sleep, I'm trying to read some of his letters. So, some of those guys, there's so much to learn, and I can't even find enough time to learn from all these people. But also other great people to learn about on a more macro level are Ray Dalio and Howard Marks. So things like things that they've put out there are really great too. And I also like Jeremy Grantham. I just read some of his recent letters on his website, GMO, which I think is like kind of a research investing firm. So yeah, from people like that, those are all, I know I combined influencers and books and learning materials, but there's just so much we can learn. And of course, Phil Town, he has a lot of great resources that are free, like investing calculators on his site, Rule 1 Investing. So there's so much that's free out there that we don't necessarily have to pay for to learn from. And also, use your local library if you can. Like, I think library systems are like underrated. Like I think they can offer so much great resource material that we don't have to buy books necessarily. We can just borrow the books or other stuff from there, and it's pretty awesome.
Yeah, totally agree. That's awesome. My last question is, how can people find more about you? Do you want to tell our listeners your YouTube channel and so forth?
Sure. Yeah. If people want to check out my videos, they can find my YouTube channel with my name, Michelle Markey. And Markey is spelled Marki and investing. So just Michelle Markey Investing on the YouTube channel. And I also have a podcast that I do with my partner, Sina Lundholt, and she's from Denmark. So it's really cool that we both found each other on Instagram, and then we went to the Berkshire meeting together, and now we run this podcast called Investing Mastermind Podcast, and people can find that on wherever they get their podcasts, like Apple or Spotify and so on. So yeah, if people want to learn more, feel free to go there, or people can add me and talk to me on Instagram if they want at Michelle Markey. So I'm sure people will be able to find me. I'm probably, out there and about. So yeah, thank you so much for, giving me this opportunity to also plug my social media.
Of course, of course. Thank you so much, Michelle. This is wonderful.